Taking a look at futures this morning, we actually have had a reversal of fortune. Right now, Dow Jones futures are up 136. S&P is at 57. NASDAQ is up 419. All three major indices did finish lower on Friday. The tech-heavy NASDAQ down more than 4%. Biggest decline since April of 2025. S&P 500 also snapping a 9-week winning streak, while the Dow facing its steepest loss since the end of March. Now, semiconductor stocks seeing a major sell-off last week following Broadcom's failure to lift its 2027 AI revenue guidance. Semiconductor stocks this morning, however, are back up in the green. There you go on your screen. You can see Marvell, you can see Micron, and of course there's Broadcom. The declines in AI-linked names also spreading to Asian and European markets overnight. Let's bring in Ironsides macroeconomic managing partner and director of research, Barry Knapp. Barry, good morning to you. So what is your reaction to what you're seeing here?
Well, I think we're in a tricky spot for the next couple of months. Not because I think we have an insidious inflation problem. I do not. Just like tariffs, the energy shock is more likely to be disinflationary, to reduce demand and growth over time and have no persistent impact on inflation. However, much of the FOMC, the staff, and the like truly believe in this expectations-enhanced Phillips curve model of inflation. It's absolute nonsense. Inflation is always and everywhere a fiscal and monetary phenomenon. But Kevin Warsh is going to have a tough time getting started with what Treasury Secretary Bessent, Warsh, and Vice Chair for Supervision Bowman want to do, which is to rebalance Fed policy away from rate hikes that are rate policy that's too tight and a balance sheet that's providing accommodation. So ultimately, they need to cut rates and start reducing the duration of their portfolio, but he's not going to be able to get started on that probably till September. Yeah. And that leaves the consumer parts of the economy vulnerable until then, the smaller business parts of the economy vulnerable until then. Even with the strong payroll numbers we've been seeing, we still have small business employment contracting by 0.3% per year when large businesses, and this is ADP data, increasing at almost 2% per year. So we have a real K-shaped economy that the Fed's failure to do this rebalance threatens to turn the K into an I. Well, you know, right? And just make it worse.
Let's pick up on this, because let's look at yields this morning, because it's exactly what you're saying. And we saw this determination on Friday by the markets after we got that May jobs report, and it came in much higher than expected. It was pretty much a blowout number. You had 172,000 jobs added. Unemployment was steady at 4.3%. But this further reduces hopes for any cuts, Ryan, because instead of increasing speculation about a hike, as he's saying here, Kevin Warsh is, he's got his first policy meeting next week, and this complicates, and we're going to get, the decision. We got CPI this week, we got PPI this week, so we have a lot of data to hand over to Kevin Warsh next week, but it's going to be rough. And their credibility, I agree, their credibility is an issue right now.
I think so, but I think what I wonder, because if you look at CPI, strip out energy, it's still going up, right? If you look at we're tracking almost 3% for in this past month. Also, I mean, I think when you have a tight labor market, I mean, those job numbers were phenomenal, right? They just blew the doors off, and we do have a shrinking labor pool with baby boomers retiring. The immigration has slowed down a lot. I'm just wondering, wage inflation is going to be a lot of pressure on that. And I just think this AI boom inherently is very, very inflationary, right? Look at the price of commodities. I mean, if you look at commodity index up over 30% this year, that's keeping prices a lot higher. So I wonder here, Barry, we're getting back to what I call normal inflation. 3% has been the average since World War II. Do we keep the heightened inflation? And if you look at small job openings, we're the best month over month. You're seeing more small job openings than anywhere else in the economy right now. That's got to be a good leading indicator that small businesses are going to start doing well, just to give kind of some counterpoints here.
Well, there's a lot to unpack with that. I'd say briefly that the small business openings number looks really dubious. It was all in professional business services, 90% of it, and that sector actually didn't create any jobs last month. So I think that that's a statistical aberration, but that notwithstanding, the broader wage issue is really not an inflationary driver here. But the point that you made that I really want to hone in on is you said AI is causing near-term inflationary pressures. So
Yes.
if that's true, you need to think about it from the perspective of how do you cool that demand, right? Because the Fed's balance sheet, the holdings of securities, the fact that they bought 24% of the last 10 and 30-year auctions, they are providing 50 to 75 basis points of accommodation for high-quality, long-term, fixed-rate borrowers, which would include hyperscalers. At the same time, we've had favorable tax policy for those from the one big beautiful bill, immediate equipment investing, depreciation, and
Yep.
the same for factories. So you're providing all this accommodation for the parts of the economy that are spurring a demand issue. That's what you should cool, not rate policy, who's going to punish small business, small real estate developers and the like. So the way, and I wrote this a few weeks ago, what the Fed should do, if they're truly worried about the inflation you're describing, the right thing to do is stop buying 10 and 30-year treasuries on auction, start shortening the duration of their portfolio, removing that accommodation, not raise the short-term rate, which, as I said, is going to turn the K-shaped economy into an I.
All right, I got 10 seconds, Ryan. You got to respond.
My only
That's
concern
interesting.
there is when Jay Powell cut rates back in, we remember September 2024, long-term rates actually went up. So I'm concerned here if the Fed isn't hawkish enough, could that inadvertently push those higher rates even higher, but maybe that'll cool down some of this.
Well, the
AI
problem in
trade.
2024 was the last year of the Biden administration, government spending growth was 11%. It's been 3% since President Trump was inaugurated. So
true.
that's what drove it up. You could see it in swap spreads getting deeply negative, 30-year, everything that responds to the supply of treasuries, which was increasing rapidly at that point, was what pushed rates up. Right now, it's AI-related demand that's pushing rates up.
Well, we're going to get CPI on Wednesday, and it's not going to be 9.1% like it was under President Biden.
No.
At least there's that. Barry Knapp,
Exactly.
great to have you on set.
All right.
Thanks, Barry.
Thanks.
Yeah.
Great.
We'll be